Chapter 4, Fundamentals of Research. Learning Objectives. After studying this chapter, you should know about investing activity and various approaches to investing. Overview of technical analysis for investing in stocks. Overview of the fundamental analysis for investing in stocks. Overview of quantitative analysis, econometrics approach. Behavioral finance approach to equity investing. What is investing? Investment in the context of securities market involves upfront commitment of a sum of money to earn returns on it over a period of time. It involves thorough analysis of the underlying security in terms of safety/risk, income, and growth potential. Investing is very distinct from trading or speculative activities. A trader attempts to earn profit by earning a spread between selling price and buying price without a necessary change in the underlying value of the asset. Thus, a trader's time horizon is fairly short time. In the context of securities market, traders are generally speculators who bet on the short-term movement of the asset prices and take suitable position to make profits. Investment activity, on the other hand, focuses on the potential of an asset's value to increase over a period. In the context of securities market, the value of an asset can increase if it can generate higher cash flow without a proportionate increase in risk, or if the risk associated with the asset decreases without a proportionate decrease in the cash flow. Thus, investing is a more complicated task requiring higher level of rigor in terms of analysis. The level of analysis can be either at a broad asset class level, or an investor may drill down deeper into individual stocks. Active investing. Active investing involves identifying the specific security or set of securities that should be purchased or sold. It involves constant evaluation of every security in the investment portfolio so that investors can sell securities that are priced above their fair value. Similarly, while buying securities, investors look to identify securities that are priced below their fair value. Thus, active investing strategies require more effort and involve a greater number of transactions compared to passive strategies. The objective of an active investor is to earn a rate of return that is above the return generated by the broader asset class. Passive investing. Passive investing involves investing in a broad set of securities that fairly represent the asset class the investor needs to invest. Typically, passive investing strategy follows indexing strategy, where an investor buys all securities that are part of an index. The objective of a passive investor is to earn the rate of return that the select asset class provides. A passive investor does not decide upon individual securities to buy or sell, but rather their analysis is limited to the broader asset class. The role of research in investment activity. The role of a fundamental research analyst comprises of two parts: 1, research, and 2, analysis. While analysis involves analyzing all the available information to arrive at a conclusion, research involves obtaining all the necessary information. For instance, a company's annual report may be a treasure trove of information about the company. However, obtaining thorough insights into the company's business and profitability involves a very detailed scrutiny of the annual report. And often, information in annual reports is not adequate. Given that annual reports are published once every year, the information contained in an annual report starts becoming dated with the passage of time. Further, several information pertaining to industry conditions or the broader economy may not be covered in depth in the company's own filings. Thus, a fundamental research analyst will have to spend significant amount of time researching on the economy, the industry, and the company as well. This may involve speaking to industry experts, accessing reports from market research firms, performing secondary research to understand what is happening in the economy, the industry, or to track actions taken by competitors. Often, research analysts may also have to conduct primary research that may involve visiting the company's facilities, speaking to customers, suppliers, employees, and others. It is, however, very important that the research work of the analyst should not involve collating insider information. Insider information in this context refers to any price-sensitive information about a company that is not available to public at large. Insider information versus Mosaic analysis. In the process of research, an analyst may come across some information that are not known to public in general. It is not necessary that all such information would fall under insider information. Insider information is a material non-public information that when published would immediately affect an investor's decision to buy or sell the security. Whether an information can be considered insider depends on the source of the information, how reliable it is, its impact, and its certainty. Thus, while a CEO talking about an unpublished acquisition proposal would constitute an insider information, an employee talking about increasing workload in the purchase department, which may indicate higher level of business activity, need not fall under the definition of insider information. Often analysts collate information from different sources which individually may not be significant, but when put together with other public or non-public information may provide critical insight to the information. These are called as mosaic analysis. Such mosaic analysis is acceptable. Analysts need to be careful whether certain insight drawn came from their mosaic analysis or by being privy to a specific non-public price-sensitive information. Technical analysis. Technical analysis is based on the assumption that all information that can affect the performance of a share, such as company fundamentals, economic factors, and market sentiments, are reflected in the stock prices. Instead, it is focused on forecasting the direction of prices through the study of patterns in historical market data, price, and volume. Technicians, sometimes called chartists, believe that market activity will generate indicators in price trends that can be used to forecast the direction and magnitude of stock price movements in future. According to technical analysis, there are three essential elements in understanding the price behavior. 1. The history of past prices provides indications of the underlying trend and its direction. 2. The volume of trading that accompanies price movements provides important inputs on the underlying strength of the trend. 3. The time span over which price and volume are observed factors in the impact of long-term factors that influence prices over a period of time. Technical analysis integrates these three elements into price charts, points of support and resistance in charts, and price trends. By observing price and volume patterns, technical analysts try to understand if there is adequate buying interest that may take prices up or vice versa. Technical analysis is a specialized stream in itself and involves study of various trends, upwards, downwards, or sideways, so that traders can benefit by trading in line with the trend. Identifying support and resistance levels, which represent points at which there is a lot of buying and selling interest, respectively, and the implications on the price if a support and resistance level is broken, are important conclusions that are drawn from past price movements. For example, if a stock price is moving closer to an established resistance level, a holder of the stock can benefit by booking profits at this stage since the prices are likely to retract once it is close to the resistance level. If a support or resistance is broken, accompanied by strong volumes, it may indicate that the trend has accelerated and supply and demand situation has changed. Trading volumes are important parameters to confirm a trend. An upward or downward trend should be accompanied by strong volumes. If a trend is not supported by volumes or the volumes decrease, it may indicate a weakness in the trend. Technical analysis converts the price and volume data into charts that represent the stock price movements over a period of time. Some of the charts used include line charts, bar charts, candlestick charts. The patterns thrown up by the charts are used to identify trends, reversal of trends, and triggers for buying or selling a stock. Typically, chartists use moving average of the price of the stock to reduce the impact of day-to-day fluctuations in prices that may make it difficult to identify the trend. Short-term investors and traders largely rely on technical signals as business fundamentals seldom change drastically in the short run. However, technical analysis is less likely to be suitable for long-term investing as business fundamentals may change in the long term. In such cases, past trend in share price would be unreliable to understand the subsequent price movements. Fundamental analysis. Unlike technical analysis, fundamental analysis is focused on long-term investing. Its premise is that since equity shares reflect part ownership of a company in the long term, its value should be driven by the returns generated by a company on its share capital. If the short-term movement in prices cause the price to significantly diverge from its fair value, it creates a profit-making opportunity. Thus, an investor should first gauge the fair price of the equity based on the expected performance of the business. If the market price is below the fair value, it represents an attractive investment opportunity. On the other hand, if the market price is above the fair value, the investor should sell the share or avoid investing. Therefore, profits in investments come from not only identifying a good investment option but also making the investment at the right price. This thought process is in contradiction of efficient market hypothesis (EMH), which propagates that share prices incorporate and reflect all relevant information. Fundamental analysis involves comprehensive study on the company's business as well as its governance style to understand the expected returns and reward for the shareholder. The various aspects that are studied in fundamental analysis include the following. How is the overall cyclical and secular macroeconomic trend and whether it is likely to help the industry grow or decline? How is the competition intensity within the industry and whether it is conducive for the existing players to thrive? How is the company positioned vis-à-vis its competitors and whether it would do better or worse compared to them? What is the cost structure of the company and how are they likely to impact profit under different business environments? How strong is the financial position of the company and whether it is strong enough to fund growth or to withstand crisis? What are the capabilities of the management and whether they can identify and execute the right strategies to exploit growth opportunities while defending the business from adversities? Whether the right governance structure is present that can ensure that the board of directors and management act in the best interest of shareholders. All the above questions can be typically put within 3 baskets. 1. Economic analysis. 2. Industry analysis. 3. Company analysis. We shall cover each of these segments in detail in subsequent chapters. Quantitative research. Fundamental research involves both quantitative and qualitative studies. However, some analysts approach equity analysis purely from a quantitative approach using econometric analysis. Quantitative approach can be used for both technical analysis and fundamental analysis. In technical analysis, analysts, instead of reading charts, focus on the underlying data. They can study the relationship between the price-up moves and down moves, the volume, and other parameters to gauge the direction of stock prices. In the context of quantitative research, analysts look for finance and operational metrics of the company. Theoretically, it is possible that some of these metrics either independently or together with other metrics serve as a leading indicator for the company's performance. At the simplest level, time series analysis and regression of historical data can help extrapolate future earnings. Quantitative analysts may use more sophisticated econometric approaches to refine their output. However, applying pure econometric approach in fundamental analysis suffers from some major limitations. Primary among them is the availability of comparable information. Frequent changes in accounting standards and business models makes past data less useful to be compared with present market conditions. Thus, pure quantitative research is not often employed in fundamental analysis. Behavioral approach to equity investing. Investment decisions have to be based on the analysis of available information so that they reflect the expected performance and risks associated with the investment. Very often, the decisions are influenced by behavioral biases in the decision maker, which leads to less than optimal choices being made. Thinking behind proponents of this philosophy is that securities prices go away from their fair values, either upside or downside, because of the fear and greed of the market participants. Some of the well-documented behavioral biases that are observed in decision-making influencing investments are discussed in detail in Chapter 11.